That just means that physical deliveries will come in December. There'll be a fight for those, but the prices can change quite a bit because they're more reflective of the paper price trading. So you could see big swings in gold and silver this fall. We'll have to see what the economic data says. The reason I do economic data stories and gold and silver reporting in the same report is because the economic data and the stories eventually lead to what is going to happen in the gold and silver markets.
Welcome to Gold Silver Pros.
Hey everybody, this is 𝘎𝙀𝘾𝙊𝙈 with Gold Silver Pros. This is your weekly market wrap-up for August 4, 2023. Thank you everybody for joining the program. We're recording this a little bit late today, about 4 p.m. Central Time, because, well, we're busy. No, we really want the data to come out, and we're going to do a little bit deeper dive into the precious metals, more so than we regularly do, just to make sure we give you good coverage of what's going on. However, before we get to that, we're going to talk about the economy and give you the macro view. This week, U.S. manufacturing continued its baby bounce from last week. The Chicago Business Barometer Index inched forward about 3%, as the index feels slightly more positive about how the industry has been operating in the past month. The ISM Manufacturing Index, a national indicator, inched forward just under 0.5%. However, construction spending in the U.S. fell about 0.6% this past month as compared to the one before it. The big report this week is on jobs, as it always is the first week of the month. The U.S. non-farm payrolls report had 188,000 new jobs, a meek print, fairly small compared to economists' expectations for the month. Earlier this week, the ADP private payroll report showed that the U.S. added 324,000 private payroll jobs, much less than last month's 455,000 private jobs added per the same report. Employment isn't surging, but can be more aptly described as inching forward ever so slowly, all things considered. U.S. productivity measures surged by 3.7%. I call it a surge based on the fact that it was a reversal of the negative 1.3% from a month ago, and that's basically a 5% swing in 1 month, which is, quite honestly, a refreshing piece of news for the nation's economy. At least that one indicator is flashing positive, and frankly, we will take it. Story of the week has to do with the big student loan problem. Research has come out from Bloomberg and from Zero Hedge and other sources that we have a massive problem brewing in the student loan market. Essentially, what's happening is there's $1.5 trillion of student loans sitting out there. A lot of them were in temporary, forbearance or in a pause because the current administration had promised to forgive a lot of those loans. Unfortunately, the Supreme Court ruled that they couldn't do that. And now what's happened, the administration's having to back up. The only thing the administration can do right now is use its executive administrative powers within that department to essentially change some payment terms, rearrange payment terms to be more aligned with people's income. But at the end of the day, they have very limited options. And the news really is that households are less prepared to make payments. We'll get to that in a moment. But before we do, the problem of the back and forth of whether people need a service or not has caused big problems. Navient, one of the biggest services in the market, just simply exited because we didn't know if those loans were going to be forgiven. So not even in the business anymore. A lot of other services have changed and moved around as the expectations for the servicing market have changed. So the market itself and the servicers have changed. So former students are logging into the payment portals because we're not going to forgive all this debt. They know they're going to have to pay it, but they don't know who to pay. They're getting passed around between different payment servicers. They don't know how much to pay. They don't know if the amount's correct. They don't know if they're in default or if it's due and when it's due. And it's caused massive confusion. The second problem with that is as 6 Democratic senators sent a letter to the servicers, they're afraid that there's going to be a lot of scammers out there, because if you don't know who your servicer is, wouldn't it be easy for a scammer to go out there and start contacting students with student loan debt and saying, hey, I'm your servicer now. I'll take your payment. They're really concerned about that. So this is a big mess. We don't know how, when, why, or what, or anything around whether these loans are going to get repaid. And honestly, ladies and gentlemen, that's a problem. But the problem goes deeper than that. We have research from Morgan Stanley that households are less prepared to make payments. Listen to these numbers as of June 23rd. 34%, slightly over 1/3 of all respondents, of all students in this survey, will not be able to make their payments. Another 37% said they can make them, but they're going to have to give up other things. And I'll tell you the significance of that here in a moment. That's pretty bad. Maybe even worse, the fact they can't pay their student loans is the fact they're not going to be able to pay other things. When you look at the under 50,000 income strata for this, the amount of people that cannot pay jumps almost to 50%. It's 47%, ladies and gentlemen. And add on 31% of people with less than $50,000 will be able to make their student loan payment, but they may not be able to make other payments, including housing, auto, and basic necessities. As you move up the income strata, there are less and less people that can't make their payments, but more and more that have to substitute other things. So in the $50,000 to $100,000 bracket, only 29% of people will not be able to make their payments at all. 41% will have to give up other things, which could be other credit products, which is problematic for the economy. As you get to 100,000 plus, the number of people that cannot pay is only 14%, which makes sense. That's a six-figure income. But a higher percentage of people have to substitute other things and perhaps not pay back other debt. That's 43%. That indicates people with higher incomes were taking more overall debt, not just student loans, thinking perhaps that they wouldn't have to pay them back. And that's the problem with promising something you can't deliver. It becomes very dangerous. And this has created an even deeper issue. First of all, people don't know who they're supposed to pay, when they're supposed to pay, and what amount. But a growing number of students or former students are not going to be able to pay at all, or they can make their student loan payments, but the rest of the economy may suffer. Further, Morgan Stanley research took a look at the second order effects of people paying student loans and giving up other things. And basically, the mid to high-end retail market is about to get slammed. Companies such as Dick's Sporting Goods, Target, Ulta Beauty, Wayfair, Women's Sonoma, specifically called out as companies that may see a sharp reduction in sales as student or former students move money to pay their student loan debt and don't buy these other things. Now, certainly, I would call subsistence level or base level goods stores like auto parts, Dollar, Kroger, Walmart, those types. And that's not a slight, meaning you have to have those things. If you look at Maslow's hierarchy of needs, we got to eat, you got to drive to work, you got to have clothing. And that's what I mean subsistence level, not that they're cheap, but people are going to shop there because they have to, but they're going to give up all their other things. So a large portion of the economy, any part of the economy that's not considered a base level brand or a base level price is going to suffer when these students can't have to pay student loans and can't buy these other things. It's not just the high-end retailers are going to suffer, it's the mid-tier retailers as well. So it'll be interesting to see if we have corporate defaults as a result of this somewhere down the line. There was additional research done by the government. It's the CFPB. It is basically the group that manages the student loans for the government and does the reporting. They're reporting that the percent of student loan borrowers in the sample that are 60 days delinquent, that's 2 months, on other credit products, not on their loans. Remember, the loans were in like a temporary pause, but thinking they'd be forgiven. They're not. But even those borrowers that had loans are already 60 days delinquent on their existing credit. That could be auto loans, that could be home loans, that could be credit cards or other revolving debt. And they haven't had to even go back and pay their student loans yet. So we've got a spike from about, it looks like about 5% in 2021 to now almost 8% of student loan or students that had borrowed loans that cannot pay their other loan products back. And when those student loans come due, how are they going to pay those? So breaking it down even more, these problems become very, very big. What are the second, third, and fourth order effects going to be? Or in other words, what dominoes are going to fall throughout the economy as people cannot pay off their debt? How is it going to affect the economy? How many banks would be affected? Because a lot of banks had financed these student loans, and when students can't pay them, we have been talking on our program in Gold Silver Pros about how the banks are in dire trouble because their liquidity ratios of free cash and the ability to withstand economic shocks is really low, and it hasn't gotten better since the spring when SVB and Signature and Silvergate and all these banks were having issues. First Republic, that situation hasn't gotten better. And when students can't pay their loans back, it's just going to make the overall debt problem worse. And the banks could be in really, really big trouble. All right, that is the story of the week. Overall, the economy is doing well. Bitcoin really hasn't moved last time I checked. Overall, the bond rates are about the same. So I'm not going to focus on that. There was a bit of a baby bump in the stock markets this week because while the jobs didn't turn out great, overall, everything wasn't too bad. We've had very positive earnings reports in the economy from a couple of big time companies, although we have to wait and see how the overall earnings of corporate America are. But that did give a little bit of boost. I think it was a couple hundred points to the stock market earlier this morning. We'll see, what happens there. Generally, not a lot of stuff is moving. The economy is very stagnant right now in terms of the numbers. So not a lot to report there. So we're going to focus now on what's going on with the gold and silver markets. And we're going to jump right into that, ladies and gentlemen. Here on the share, you can see goldprice.org's prices, where we quote our prices every week. Gold is actually up $7 today to 1942.80. It had slumped the last couple of days, and we'll get into that data here in a moment. Silver is up 3 cents to 23.63. Both very modest gains, but hey, at least they're up to end the week. We're going to look at the chart. Here is the COMEX gold chart, the futures trading chart, and you can see that on the short-term moving average is a 10 and 25 day. The 10 is the red line, and the blue line is a 25-day. Gold has slumped. So on a short-term basis, gold has slumped. If we do a 50 and a 200 day, a longer term and more probably accepted period of moving averages, we're going to have to break out to a 6-month chart. And we can see that gold is underneath its 50-day moving average. And if we break it out even more to a 1-year chart, let's see the 200-day moving average. Gold is still above the 200-day. So they're not in a major slump. It's a minor slump. Over the short term, we've had a little bit of pullback in the gold futures prices. Nothing really to write home about, nothing to panic about if you're a gold and silver investor. Here's the telltale on the 𝘎𝑚A group, which runs the markets. You can see volume is really low in gold. Generally, that's pretty good. It means it's not being slammed down by shorts at least. And you can see here the overall totals of the market. Today so far, as of about 9:30 a.m. on August 4th, this data, they don't have very late data for us. We had 44 gold deliveries for the month, 3,154 EFP, which basically is moving over to London OTC market to ostensibly get the price difference there on the contracts or potential physical access to the unallocated gold in that market. No guarantee they're going to get it, but it does give exposure to different reasons companies want to do that. Overall, it looks like a nice, healthy trade. Of course, December is now the overwhelming dominant month in gold, so everything's going to roll into that December contract, and that's where you're going to get your next big set of deliveries. Although overall deliveries haven't been too bad for the gold and silver market. We'll go over delivery data as well. Looking at the settlement data, up $7 today, but earlier today, and I'm looking at this change column here, we were down about $5 to $6 on Thursday. We were down about $3 on Wednesday, and on Tuesday we're down $30. So to start the week, it was down just a bit, but we slowly sort of recovered this week. It's a sideways trading market. Nothing big to see there, but I like to show it to you. Looking at gold deposits around the world, COMEX is the U.S. depository. Most of these ETFs are in the UK market, some in the U.S. as well. So we like to look at the U.S. market is about even in terms of the gold change, about 22,000 ounces up total in the depositories over the last 4 weeks. Nothing to write home about in the last month. But you've seen a lot of gold roll off of the international markets to the tune of over 1 million ounces. As you can see down here, most of that rolling off of the GLD, which is the ETF. That ETF is the one that a lot of people invest in when they're investing passively and they don't want access to the physical, but they want to get access to ETF through their 401k or brokerage accounts. Easy way to invest to get price exposure. The ounces have come out, and you can see that trend is dating back to about 2020 with the pandemic as well. Nothing big has changed. I also like to look at the GLD data from a fund flow perspective right off of their website. And you can see lots of selling of the shares of the GLD. It's a share based, not physical based, but that often indicates investor sentiment in gold is slightly bearish, but the gold futures prices have held up, which tells me the industrial markets are nice and robust, or the investment markets, the big investors are really wanting to support gold. What's happened is the retail crowd, as indicated by GLD, is a little soft, and that's okay. At summertime, it happens, selling may go away, but the industrial markets and the big players in the market want gold, and that's really what matters. Moving over to silver here on the CME, you can see that there was slightly elevated volume, not a whole lot going on as of today's data. On the Globex, 69,233 contracts traded. They're open still, 137,000 for the month. There was only 7 deliveries. Over to London went 2,760 contracts, and private contracts on Clearport 3,010. Overall, nothing to write home about. Sideways trading market. As of about 1:32 p.m. in the silver market today, we've had silver up anywhere from, it looks like 1 to 2 to 3 cents in the various futures months. Yesterday, it was down 17 to 18 cents on Thursday's data. Wednesday's data is down 45 cents. So silver was more volatile this week, 64 cents down on Tuesday, but it's starting to recover. That's normal. When gold goes down, silver goes down more. Nothing really odd to see there. minor weakness in gold and silver futures markets and spot prices. I'm not really all that worried about it. On the screen here, you can see the report of what's going on in the gold and silver markets from an ETF perspective. And this is where the depositories are and the ETFs are. These are the COMEX depositories. I tell you this every time. Most of this is sitting in UK, not all of it, but it's a good proxy for what's going on in the UK. The big one, the SLV, has seen redemptions of almost 16 million ounces in 4 weeks. That's big. A lot of that seems to have come over the American market. At least at the same time, people are pulling physical out of the SLV ETF. A lot of that physical came into COMEX. Now, that didn't come into the actual trading futures market on COMEX. It came into private depository storage. So we don't know if that silver will eventually make it to the open trading market on COMEX, where the big guys can go take it. Delivery of it, we'll have to see. But at least some of the next stage or earlier stage potential storage, which could potentially move to the COMEX, has increased a little bit, which you can see here in the numbers. It's to the tune of about almost 7 million ounces. Overall, though, across the global markets, about 14 million ounces of silver have come off when you're looking between London and the US. Moving to the silver chart, same thing here. Silver is weak on a short-term basis, a 10 and 25-day moving average. If we go to the 50 and 200, which is pretty standard for more of a medium-term view on what's going on, silver is the exact same story. It's dipped below its 50-day moving average, the red line. The blue on the 200, it's still above and found support. You can see it bounced off here. It's re-challenging. As long as it bounces back off, that means we're probably, at least from a technical perspective, headed into a bull market in the fall. As we look at the retail trade in SLV, remember that's the ETF that you see here, same number. We're expecting to see a lot of selling. Well, when you go there, that's exactly what we see, a lot of red. So the retail's a little bit weak on silver, although silver is doing okay on the industrial markets because it's used a lot. Moving over to London, gold's about the same in London storage. Silver's ticked up just a tad bit in the last month in London. Looking at the deliveries, year to delivery notices were on the main gold product on the futures market. In other words, when you're looking at deliveries here on this screen, and I show you deliveries for the current month, deliveries, this is what this report shows you in tabular format for the whole year. This is year to date. So I'm blowing it out and looking at a year of deliveries instead of just a day. We've had healthy deliveries in August to the tune of 7,746 contracts of 100 ounces of gold. Not super robust, but then again, August is not usually a big delivery month. The next time you'll see big deliveries is likely to be December. So it'd be this last column. You're likely to see maybe 15 to 20, 30,000 contracts. We'll have to see what happens, but that's usually a pretty big one. If we move down to silver, you got to scroll through all this other stuff to get to silver. 5,000 silver futures. Here we go. This is silver, the 5,000 silver futures, again, year to date. So we're looking month by month. Oh, a healthy 788 deliveries on the physical deliveries on the American market. Last month was better at 5138. Again, December is going to be the big delivery month for silver. You could see some deliveries in here up until then, but a lot of it's going to be delayed demand until December. And I fully expect in the intervening months, if people really want silver, they may have go over to London or somewhere else, maybe make a contract directly with the miner. That's been known to happen. Okay, one of the last data sets we're going to look at. I know I'm throwing a lot at you, but if you've ever watched a weekly market wrap up, you know what this is. You know what we do. If you've never seen this before, put it on 0.75x speed, slow it down a little bit, and it'll make more sense to you. I realize I do talk fast, but people want this to be short and sweet, and that's what I aim to do. So we action pack this baby with as much data as we can. The swap dealers, the smart money, the bullion banks, the big dudes like JP Morgan and HSBC actually dropped shorts. They went long to the tune of about 3,200 contracts in silver. Why did it fall? The managed money dropped. They dropped longs and they added shorts to tune about 7,000 contracts. It's the financial houses, ladies and gentlemen, that are dumping silver, not the bullion banks. Same thing with gold. The swap dealers dropped some shorts and added longs. They went net long about 2,500 contracts in gold through August 1st. That's a couple of days ago. The managed monies are the ones selling. They sold 8,800 contracts and added 6,477 short. The financial houses were taking profits. Gold and silver had done relatively well over the summer. It didn't have a big boom. The managed money types typically don't understand this market very well. They sold it. I would not have sold into a sideways trading market like this because it probably guaranteed some losses, all things considered. I would have held it into the fall, rolled those contracts over. They obviously didn't want to do that. They didn't want to pay the fees to keep those contracts open. The bullion banks are doing the opposite. They're going long because they know in the fall it's going to be bullish. So again, the bullion banks took advantage of the lesser well-educated people that run the financial houses. And ladies and gentlemen, that's just the way that it goes. All right, we're going to try to present the actual stock numbers on the COMEX depositories, which you can see here. We have the Excel spreadsheet up, ladies and gentlemen. This is for gold. I've got highlighted right here. Now you'll find something very interesting. This is the previous total the day before. This is a daily report, activity date for yesterday. So these were the stocks yesterday. I'm sorry, 2 days ago. These are the stocks on the 3rd, right here, activity date, reported a day later on the 4th, but this is through the 3rd. So this is August 2nd's totals of actual storage at these depositories supporting the American futures market. This would be yesterday's data. And as I do a minus, as I take this number, H14, minus this number, in other words, what's the diff between these two dates, the 2nd and the 3rd? Notice how none of the depositories is reporting a single ounce of gold added or taken away. Let me say that again. None of the depositories supporting COMEX are showing a single ounce of movement in an entire day's report from any of the COMEX approved depositories. I find this interesting because I never in my 4 or 5 years of looking in detail at these reports have I ever seen this before. Is this a true report? I don't know. This is what the CME group is reporting. Sorry, that's just what I see on that report. We're going to move over to silver stocks. We're going to present those. Share on the silver stocks, and here we go. On silver, we did have movement. The big movement is that about another almost 2 million ounces moved into the Delaware depository eligible. That is not for trading on the exchange. It could be private storage. It could be eventually moved to the exchange, but it doesn't increase the liquid silver available on the American market. Just the potential that some of that could become liquid if the owners decide it should. Of course, it could already be pledged to some other purpose. We don't know. And now we have Loomis, same thing, 322,800. So, yeah, about 300 million ounces. It looks like about 300 million ounces moved. Sorry, that's 3 million. Oh, it's very confusing reading this board. Anyway, we had a sizable amount moved into Loomis. Expected to see that. So overall, silver stocks increased on COMEX, though, again, that's not the tradable silver. That could be tradable silver. We'll see what happens. Sorry for the formatting on the report. That's just the way it goes. So overall, sideways movement in the regular markets. Bitcoin's not really going anywhere. Bond rates aren't really going anywhere. Employment, it's tepid. Not really good or bad economic data. Generally, a flight out of gold and silver out of the market. Silver more pronounced over the international markets. A little bit of weakness in price this week, but nothing that breaks any sort of technical indicator that we're worried about a big slide coming in gold and silver. And in fact, I think the positioning by the bullion banks indicates that they're going long leading up to the fall, at least repositioning for long. And December is going to be the big showdown month, as it typically is gold and silver. That doesn't mean that gold and silver prices can't move between now and then. That just means that physical deliveries will come in December. There'll be a fight for those. But the prices can change quite a bit because they're more reflective of the paper price trading. So you could see big swings in gold and silver this fall. We'll have to see what the economic data says. The reason I do economic data stories and gold and silver reporting in the same report is because the economic data and the stories eventually lead to what is going to happen in the gold and silver markets. When there's more uncertainty, people buy more gold and silver. When there's less uncertainty and people feel generally good about other things in the economy, people will sell gold and silver. That's why we put the report together the way that we do. Thank you, everybody, for joining. Have a wonderful weekend. Until next time, this is Rob 𝘀🃗🃗 on goldsilverpros.com.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.